Good evening, everybody. It is Thursday, January 19th, 2012. Looking at the SPY chart, which is the S&P 500 ETF for the S&P 500. And this chart is going back 18 months. So you see the high we had at 134.95, then the lower high 134.15 back in June, and we had the big decline down to 109. It was on the Greek concerns. Then we had a lot of other Greek concerns over the summer, and our markets never broke down quite like Europe's. Basically, the perception is that the United States is strong on its own, and it's not going to be brought down by Europe. We held the 106 area. Turned out to be a low. We had a huge rally off that, popped to 128 and back down to 115. And as you see here, we're coiling, and we're in a wedge pattern. This is a wedge pattern, and it's going to break one way or the other. And I tend to think that it's going to be down. I don't think we're going to take out these highs of 134.95. Volume, as you see from the August period, as we formed this wedge, was really high at the initial decline, and then volume has gradually tapered off. And this rally off of SPY 120 in really mid-December is like a 15% move in a span of less than a month. Has been very anemic volume. I mean, some days it's been off 40%, 50% off of what just an average day's volume was back in the second week of December, which is a notoriously slow time of year. As you see here, the MACD put in a high. This was coordinated with the 128.60 high, and the MACD now is lower, so it's setting up a possible divergence. You've had the stochastic has been above 80, so it's embedded. So that's why it's staying strong, even though the volume is light. Until there is a big reason to sell, it is still a buy, and most likely when it does break, there's going to probably be a churn effect, meaning it's going to churn around this level for several sessions before it actually finally breaks down. So that's what I foresee happening. So the volume's anemic, the stochastic is embedded. The ADX down here, if you see, is also coiling, meaning that the highs, the green lines is when the market is rising generally, and it looks like it's going to put in another lower high here. So we're hitting this apex of the triangle, and it's going to break either way. I suspect it will be down. The only reason why stocks and the economy are generally going up is that the perception that money printing is going to is going to lead to prosperity. I don't think anybody is really betting that things are going to improve. You have a lot of austerity in the pipeline. It looks like the Greece right now is having a hard time negotiating any settlement with their bondholders, and it looks like they may wind up triggering the credit default swaps to become active, and that could cause a lot of panic. And if they do set up a deal, it would encourage other nations such as Portugal, Italy, and Spain to possibly also default. So it doesn't look like a deal is likely or would make sense for the bondholders. They're probably going to hold out and try to recoup their money in government bailouts when things collapse, so to speak, like a 2008 Lehman Brothers type situation. That said, looking at the VIX chart here, the volatility index chart. I actually wanted to look at the daily for this. And as you see here, the VIX has been finding support against this declining trend line, and trend line becomes more viable as it's touched more times. As you see here, it's been pretty oversold on the daily. It's been embedded in December, and lately it hasn't been embedded, but it's having a hard time pulling up and making a new high above this like 30 or 40 area here. You do have the histogram ticked up, and now it looks like it's potentially rolling over. Today the VIX hit the bottom Bollinger Band and it bounced off it. At the end of the day, it is holding that blue line still, which you know is worrisome if you're long the market, because basically when the VIX rises, the market sells off. So as you see here, the VIX looks like it's pretty washed out. The MAC, you have a bullish MACD cross, even though the MACD is below zero, and you have the positive divergence set up here. So you know, anything could trigger this off. Bollinger Bands are tightening here, and I suspect that over the next few sessions you will get a pop in the VIX and start the sell-off in the market. You had earnings today after the bell. You had Intel, you had Microsoft, Google, IBM. Google was a big disappointment. They were down almost 8% when I checked after hours. Looks like Microsoft was up a little bit and Intel was up a little bit. The earnings were in line, slight beats, but down the line, I would venture to think that the tech company is going to have a hard time, because a lot of their exports go to Europe, and the strong dollar is going to hurt the global corporations. As you see here, this is the VIX hourly. You have a nice positive divergence set up here, and you're pretty oversold. Not much else to say here. Just you know, another thing to look at to show the lack of volume is well, here's the hourly. You can see there's a negative divergence setting up here clearly from the high at 126. The MACD hasn't been able to eclipse that. You have the histogram ticking down a little bit. Again, you're above all the moving averages, so it's still in a bull trend. You had the RSI here. You have a negative divergence here, as you see at the other peaks. The RSI has been a little weaker each time, and you're having a second attempt to make another rise in the RSI here. So the early part of tomorrow will be interesting. Could have a gap up, and then possibly a sell into the gap. To look at the volume again, look at the daily chart. Just look at a shorter term time frame. As you see here, you have the high 128, and the MACD is lower, even though the price is higher. Now you have the embedded stochastic, but you can clearly see here how the volume has just been very anemic on this up move. And if you see a lot of throughout this move off of 120, this candle right here, this red candle, then all of a sudden it jumps up to this white candle. That was a gap up, which is the market opened up because of futures trading overnight. And a lot of this rally, you have several gaps. Most of the rally actually is gaps. So there hasn't been a lot of intraday buying pushing the market higher. It's just the market, when trading starts, it's already up, and then it just kind of holds its own and then eventually squeezes higher at the end of the day as sellers don't step in. So the market is going up on complacency and expectations that governments are going to bail out everybody and everything's going to be just fine. If you believe that, then you would want to stay long this market. But as you see, you have a pretty huge move off of the low of 106 just back in October. You're talking about a move of about 30%. I would definitely be cautious here. Very low volume, very low VIX. You have a strong dollar. You have a strong treasuries. Treasury market is 40 times bigger than the stock market, and people don't seem to have any problem pouring into treasuries. If you look at the treasury chart for the time frame. I'm going to type it in here. This is the TLT, which is the 10-year, the 20-year Treasury bond fund, and people have been just willing to pour into it. As you see, it had a low of 92.50 back in August, and it's risen to 123, and it's still holding its own at 118. If this rally was for real, you should see interest rates rising as the outlooks for the economy would be rosier, but it doesn't seem like big money really believes that, so that's something to consider. Then you also have a very low VIX, which means a lot of complacency, which is a contrarian indicator, and the VIX is very oversold. And then you have the dollar rising, which affects globalist corporations and their profitability. So there's a lot of things to consider on the downside, and then also I'm not going to go into it, but there are a lot of my opinions on things going on in the economy and the direction it's going lead me to be cautious here, and I would be willing to take chances shorting certain stocks right here. It might be a little early, might run up a little more, but I feel comfortable shorting as long as we stay below that 135 area on the SPY. If it got above that, then you'd want to take out. Right? Thanks a lot. This is it for today. Have a good day, and I'm going to be posting some more videos soon.